The first available ETF in the United States was ticker symbol SPY, which tracks the S&P 500 index. It became available in 1993. Fast forward to today, and we have well over 8,000 ETFs to choose from. We constantly hear about the new flavor of the month ETF that's going to dominate the market moving forward. It's important to have a solid screening and evaluation process to select the best ETFs to grow your wealth long term. Never blindly follow the advice of anyone before doing your own research, unless it's me that you're following. I'm just kidding. Always do your own research. In this video, I'll share the process that I use to research new ETFs that I hear about from other investors or that I read about online. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. If you enjoy videos like this one, smash that like button, subscribe, and tell a friend. And most importantly, drop me a comment down below with your process for evaluating stocks or ETFs. Let's grow. The power of ETFs. ETF is short for Exchange Traded Funds. It's a basket of securities that operates much like a mutual fund. ETFs will typically track a specific index or sector. One thing that I like about ETFs that mutual funds don't offer is that they can be traded in real time just like individual stocks. The price of an ETF is constantly fluctuating from when the market opens until it's closed. Unlike mutual funds that only reflect all changes once a day, and that includes your ability to buy or sell a mutual fund. ETFs will help diversify your portfolio when used properly. Instead of hand-picking individual stocks that could fall at any time, you just buy the whole basket, which can help mitigate your risk. However, picking the right baskets is crucial to building stable wealth. Let's get into my selection process. ETF screener requirements. A screener is a set of rules or criteria that results in a pass or fail. None of us have time to research 8,000 ETFs, so the screener will get rid of anything that doesn't meet your bare minimum base requirements. For example, you could set a rule on your ETF screener that eliminates any ETF that has under a 1% dividend yield. Or you could eliminate all ETFs that haven't paid a dividend for at least 7 consecutive years. There are many elements that you can screen for, and you can make the criteria whatever you want to suit your needs. I have 2 bare minimum requirements for considering an ETF. The expense ratio of the ETF must be 0.50% or 50 basis points or less. And I really prefer that it be under 0.20%. But 50 basis points is the maximum that I will consider. And the fund must be passively managed. I normally look for passively managed ETFs that have expense ratios of 0.10% or less. And you may be thinking, wow, Jeff, that's a little extreme there. But I'm telling you, the compound effect of expense ratios is unbelievable. They really do obliterate your net worth over long stretches of time. Let me show you an example. I'm out on the website NerdWallet, which has this expense ratio calculator that shows how the costs compound over time. So in this scenario, we will be investing in ARKK, A-R-K-K, Kathy Wood's fund, and it's an actively managed ETF with a 0.75% expense ratio. And so I put that in here. I said we have no initial investment, say it's someone fresh out of college. They have 40 years to invest. Rate of return will assume that she can get the market's return. Actively managed funds usually fall well short of the market's return. And again, the amount they actually return, not what they project. And then we're going to put in $500 a month. So when you hit calculate, which I had already done, you'll have a cool 2.36 million at the end. And you've given the fund itself just with 0.75%. You've given up over $500,000 here in fees. That's how this adds up. And if you have a financial advisor do it for you, that's usually a 1% assets under management fee at the minimum. Usually there's other fees too, but we'll just take this case. You're looking at $1.1 million of fees and only sitting on $1.8 million. The requirement of being passively managed is even more set in stone than the expense ratio rule. Passively managed ETFs will track the performance of specific indexes by using replication techniques. This is incredibly important because it takes that human gut decision-making element out of your portfolio. If you've been around the investing world long enough, you've seen how misleading the sentiment or predictions could be at any point in time. Let's use the popular actively managed ETF ARKK, ARKK, managed by Cathie Wood, as an example of what gut decisions can do over time. I had so many people telling me I have to buy ARKK if I want to crush the market in 2020, and I'm so glad in hindsight that it didn't meet my requirements. I'm going to use my favorite passively managed growth ETF, VGT, along with one of the main indexes, the NASDAQ 100 ETF ticker symbol QQQ, as the comps here. I've pulled up Cathie Wood's ARKK Innovation ETF, and I've also pulled up QQQ and VGT, as I mentioned earlier. And so where we're at here is on the charting, and we're looking at total return. And it starts on year to date. Obviously, there's only a couple days so far in 2024, so this doesn't mean anything. And I'm recording this video on the 5th day of the year. When you come here to 1 year, you see ARKK kick some butt. It beat QQQ and it beat VGT over the last year. And you think, wow, that looks pretty good. It looks a little crazy, but ultimately it won. When you look over the last 3 years, ARKK has a negative 61% total return, whereas QQQ is up 30% and VGT is up 35%. And when you zoom out 5 years, ARKK is up 26% to QQQ's 159 and VGT's 189. And you can't zoom out 10 years. ARKK hasn't quite been there the whole time. So this won't be an accurate comparison. You can compare QQQ to VGT, but this isn't fair to ARKK because it started in here. So 5 years is our maximum here. And wow, is that terrible. And it's not just about the returns, because you could buy when it's low and shoot up to the moon. That's just how this works. Or you could buy up here if you're dollar cost averaging in and lose a whole bunch of money. But the bottom line is this fund is based on human gut decisions. And look how it compares to the stability of the crazy indexes, the tech heavy wild indexes compared to the S&P 500 or dividend stocks. So these two top ones here are the crazy ones, but you wouldn't know that because actively managed funds are all over the map. There will always be people that will crush the market with some big bets, like Cathie Wood or Michael Burry, for example, and many others. If you look at Cathie Wood's performance consistency over the years, and pretty much all of Michael Burry's predictions since The Big Short, they've been devastatingly terrible. But people follow their advice because that one moment in time. Find systems that work over many decades and stay the course and avoid the new bandwagons. Let me get out in front of this and throw myself under that bus before we move on to the next section. I do hold one actively managed ETF, JEPQ, in my portfolio. However, this is strictly in my cash section to complement my money market VMFXX. I like its methodology for producing income, and I love the index that it's based on, the NASDAQ 100, or QQQ. And the 0.35% expense ratio is very nice for an actively managed ETF. That said, I still don't hold it in my portfolio of long-term investments. Let's move on to the key metrics now that we have the screener taken care of. Key metrics. I look at the following key metrics before buying an ETF. These key metrics are listed in the order that I research an ETF, but they are not listed in order of importance. I look at the expense ratio because you saw how those add up earlier, the assets under management to make sure that the ETF is well funded, the management methodology, the sector breakdown, the top 10 holdings, both what companies they consist of and what percentage of the overall ETF the top 10 are, the dividend information, last and most importantly by a mile, total returns. The goal of us investors is to ultimately make money, and everything that we talked about rolls into total returns at the end of the day. Let's walk through an example of my process. Let's say another investor tells me about this amazing dividend ETF known as SCHD. I've never seen or heard of this ETF, so I would take the following steps to begin my research. The first thing I do is come out and type in SCHD in Seeking Alpha, and you can see here it pulled up the Schwab US Dividend Equity ETF. Here it is, and I see it's $76 a share. That's great. Okay, and right here from the summary page on Seeking Alpha, the first thing I'll look at is the expense ratio. And I can see here that the expense ratio is 0.06%, which is a very low expense ratio, and that will help preserve our wealth. And then I like to look down at the assets under management, and when you see 52 billion, anything 5 billion and more, you know it's a well-established fund. SCHD has really grown in popularity, so 52 billion is a green check mark. The next important area is the fund profile. I feel that this is the most important aspect about an ETF, how it's managed. And I can see here that SCHD seeks to track the performance of the Dow Jones US Dividend 100 Index by using full replication technique. That tells me it's passively managed. The next step, and I'm not going to do it here, is I'll go research, well, what is the Dow Jones US Dividend 100 Index? How is that managed? What's its methodology? And once I've confirmed that I'm not relying on human gut decisions, I'm ready to move on. So the next thing I check out is the sector breakdown, just to make sure it's not overly heavy in one sector, unless that's its niche, such as VGT. But in SCHD's case, a quality dividend ETF, I'd like to see some nice balance here. And I can see that industrials, healthcare, financials, technology, and consumer defensive are very well balanced, anywhere from 12 to 17%, has some energy and consumer cyclical. We're good here. It looks well balanced. The top 10 holdings, I like to take a quick look at the companies and make sure they're recognizable, or do my research if they're not. And these are big, solid dividend companies. Make sure that it's not overly weighted in any one holding. And the top 10% being 41% is pretty solid. And then I like to see how many holdings it has. And after reading that description, I figured there'd be 100 or so. And here it is. It's 100 companies, 104 holdings. So far we pass. Then I move to my favorite aspect of investing, and that's the dividend scorecard. So here under dividend summary, I can see that its current yield is 3.49%. That's a very solid yield. I like to look at 5-year growth rate, and 13% is incredible. That's what you compare to inflation or your yearly raises. And then 12 years in a row of growing its dividends is great. And just to make sure the 5-year growth rate doesn't have any funny business, a lot of times I'll go check out the 3-year and the 10-year dividend CAGR, compound annual growth rate, as well. And I see here 11 and 9. So the 5-year is the highest, but it looks like it's fairly solid every single stretch of time. Then I usually take a quick glance at the dividend growth. $1.05 per share in 2013. It's all the way up to $2.66 in 2023. So it's growing its dividend very well. And the last thing I'll look at with an ETF is the charting tab. And I always put it on total returns to include dividends. So normally I'd put my other favorite dividend ETFs here to see how SCHD compared. But for now, I just pulled up the market VOO, and you can see SCHD underperformed last year. So I need to do some research why that was. Over the last 3 years, it's been right there at the market, a little bit ahead, in fact. Over the last 5 years, it's right there, lagging a little behind, but with a dividend ETF with its higher 3.5% yield, that likely makes good sense. And then over the last 10 years, same concept, 186 to 206. At this point, I would think SCHD warrants further examination.
SCHD looks pretty darn good, but I still wouldn't buy it at this point. Now I would add it to my ETF tracking spreadsheet that I maintain to see how it compared to the other comps that I've added over the years. Let's check it out.
This is the spreadsheet that I use to track the ETFs that I either own already or could buy in the future. And your version may be a little different. I pull a screener from Seeking Alpha and dump it into this. So anything black is a formula that automatically updates, and I just have to update the blues. But the bottom line is you just want to track the pertinent information of all the tickers you may consider. I would suggest saying their role, because you want to have a nice mix of growth ETFs, dividend ETFs, and cornerstone is either a total market or an S&P, or a hybrid fund like a VIG that has lots of growth and dividend stocks. So, this is like a 1.9 yield. So it's clearly not a dividend ETF like SCHD. It's more akin to VOO with a hybrid approach. So just the role in the portfolio, assets under management, holdings, top 10 holdings percentage. This is more just for information. Make sure it's relatively balanced. If it's passively managed. And then I pull in all the metrics we've talked about in this video. I do expense ratio and then what it ranks compared to its peers, dividend yield and its rank, 5-year dividend growth rate and its rank, and 10-year total return and its rank against its peers. Oops, I need to scroll over a little here. It's hard for me to see what I'm doing. This is an awkward screen share. But then I give it a total rank is just the average of all these ranks. And again, this doesn't mean it's the best. I just like to use this for reference, and I sort by this when I'm assessing different ETFs. But this is my long-term tracker. I have something similar for short term and something with a whole bunch of columns that just kind of does the whole 9 yards. But the bottom line is, however you track it with your watch list or your stats and metrics, it's good to follow these things for a while before you buy them.
I like to track an ETF long enough to see how it handles a variety of macro situations before I start a position. I'll be sharing my full portfolio soon on this channel to provide insight on the moves that I make and why I make them. Buy and hold, but stay open-minded. I currently have a portfolio mix that has outperformed the S&P 500 every single year over the last decade. But that doesn't mean that the current portfolio will continue to work forever. My strategy at a high level is to dollar cost into quality ETFs and hold them forever. But we must also stay open-minded to the changes going on around us. And this doesn't mean that you jump on every new trend, because that's a surefire way to deplete your net worth. Stay patient, do your homework, and you'll know when to evolve your portfolio over the years without making any knee-jerk decisions. Making fewer moves is the most proven way to get rich in the investing game. Check out this video right here if you want to see specifically how I've outperformed the market each year without really doing a whole lot at all. Thank you for watching, and I will see you here every single Thursday and usually on a Sunday. Peace.